SBI Funds Management operates as the unquestioned apex predator of India's mutual fund industry, steering a massive share of the nation's invested wealth. The sheer scale of their operation is staggering. They control roughly 15.5% of the total mutual fund industry, holding 16.32 lakh crore rupees in assets under management. For retail investors, the company's upcoming IPO presents a rare window to purchase direct equity in this market leader. This table breaks down the entry mechanics. You're looking at a price band of 545 rupees to 574 rupees per share. The minimum lot size is 26 shares, meaning a single retail application will require an upfront investment of roughly 14,924 rupees. At the upper end of that price band, the company is demanding a total market capitalization of 1.17 lakh crore rupees. The immediate question you have to ask is whether a company already this massive can actually grow fast enough to justify that premium. The size of this public offering reflects the size of the company. It is a massive $11,692.91 career issue, but there is a specific structural catch to how this IPO is built. It is a 100% offer for sale. In practice, an offer for sale means the company is not issuing a single new share. Instead, the existing shareholders are cashing out a portion of their equity to the public. In this case, those exiting shareholders are the original promoters, State Bank of India and Amundi. The direct consequence is that absolutely 0 rupees from this 11.6 thousand crore IPO will enter the company's treasury. None of your capital goes toward funding new operations, expanding technology, or hiring staff. This forces a crucial decision. You are paying a premium valuation purely to provide exit liquidity for the founders. You have to decide if the company's internal profit engine is powerful enough to make that offer for sale structure completely irrelevant to your returns. To answer that, we have to open up their internal financials and see what you are actually buying. The core thesis for buying this stock lies in their aggressive and remarkably consistent profit generation over the last 3 years. This chart illustrates bottom-line momentum. Profit after tax leaps to 3,067 crore rupees in FY26. Contrast this with the offer for sale, where 11.6 thousand crore rupees bypasses the company to promoters. However, extreme efficiency converts 3,597 crore rupees in FY25 revenue into a staggering 3,412 crore rupees EBITDA. With no new capital entering the business, you are buying a highly efficient, self-sustaining cash machine, relying entirely on its existing momentum to expand. Maintaining those extreme profit margins requires a constant, cheap influx of new retail capital. SBI AMC solves this through brute force distribution, leveraging State Bank of India's reach alongside over 132,000 independent mutual fund distributors. That sprawling infrastructure successfully captures a massive audience, resulting in an active base of around 18 million unique investors. Crucially, they manage that base at a very low cost. Over 94% of transactions in FY26 were executed digitally through platforms like Yono and InvestiTap. The mathematical trade-off here is the law of large numbers. When your asset base is over 16 lakh crore, it takes a massive absolute influx of new capital just to move the needle by a single percentage point year over year. Their distribution moat provides an incredibly safe, reliable revenue floor, but the sheer scale of the operation makes explosive, startup-like growth nearly impossible going forward. If the financials align with your strategy, the actual mechanics of applying require specific capital planning. For investors targeting better allotment odds in the big non-institutional investor category, you are required to apply for a minimum of 68 lots, which locks up over 10 lakh rupees in capital. That capital leaves your control for almost a week. If you don't get an allotment, funds are unblocked on July 17th. If you do, the tentative listing date is July 21st. Once listed, the stock will begin fighting for liquidity on both the National Stock Exchange and the BSE. High net worth individuals have to weigh this trade-off carefully. The NAI tier offers mathematically better odds, but you suffer a severe opportunity cost by freezing significant capital while waiting for the allotment lottery. Pulling 11.6 thousand crore rupees of liquidity from the market, the sheer weight of this offering will likely suppress any listing day premiums. So, taking all the data into account, should you actually tie up your capital and apply for this IPO? This quadrant matrix maps out your options based on two variables: your investment horizon on the bottom axis and the amount of capital you plan to deploy on the side. First, the retail listing flipper. This is the investor applying for a single lot, hunting for a quick 30% pop on listing day. If this is you, temper your expectations or avoid it entirely. The 11.6 thousand crore gravity of this issue size makes a violent day one price spike highly unlikely. Second, the long-term compounder. This is the retail investor looking to build a core, fundamentally sound portfolio for the next decade. This profile is a perfect fit. You are securing equity in a highly regulated, high-margin market leader. The short-term listing volatility shouldn't matter to you. Finally, the high net worth investor, deploying anywhere from 2 lakhs to over 10 lakhs purely to increase their allotment odds. You should only utilize this capital-heavy tier if you are fully aligned with the long-term compounding thesis. The opportunity cost of locking up 10 lakhs is simply too high to risk on a mediocre listing flip. SBI Funds Management is a mature, highly profitable compounding engine. If you decide to apply, align your strategy with the sheer gravity of its size and invest for the long haul.